The Forex scandal, when the world's biggest banks cheated together. Hey everyone, welcome back to the channel. Today, we're talking about one of the most jaw-dropping financial scandals in modern history. Picture this, it's 2013, and regulators discover that the world's largest banks have been secretly rigging the $4.7 trillion per day Forex market. That's every single day, mind you, for over a decade. That's not just fraud. That's coordinated deception on a scale that's almost hard to comprehend. So what happened? Who got caught? And what did it cost us all? Let's dive in. The setup. Welcome to Forex. Before we get into the scandal itself, let's break down what the Forex market actually is, because if you're new to finance, it might sound super complicated. The Forex market is where currencies are traded. Every time a US company needs to pay a supplier in Japan, or a British tourist exchanges dollars for euros, that's a Forex transaction. It's the biggest financial market in the world, larger than stocks, bonds, and futures combined. And here's the thing, most of these trades happen behind the scenes between banks and major institutions, not on some central exchange like the stock market. This decentralized nature is crucial to understanding how the scandal happened in the first place. What actually happened? In June 2013, Bloomberg News published an explosive report. Currency traders at major banks were casually chatting about manipulating the Forex market. We're talking about dealers at institutions like Barclays, Royal Bank of Scotland, UBS, Citigroup, and JPMorgan Chase. They were using private chat rooms, ironically nicknamed things like the Cartel, to coordinate their actions and cheat their own clients. Here's how it worked. When a client wanted to exchange currencies, these traders had advanced knowledge of these orders. So they'd front-run them, meaning they'd trade ahead of their customers to take advantage of the price movement they knew was coming. It's like if your broker told you he was buying Apple stock tomorrow, so he bought it today himself, made a quick profit, and then executed your order at a worse price. Except this was happening at the world's most powerful banks, on the world's biggest market, orchestrated across multiple institutions. And it wasn't just one or two rogue traders. These were teams of dealers, working at competing banks, collaborating in these chat rooms. One chat message that regulators found showed a trader from one bank asking, "If you know of any cable fixing tomorrow, please let me know and I'll keep my bids offers up." That's straight-up collusion. Why did they do it? This is where human nature and incentive structures collide catastrophically. These traders had their bonuses tied directly to their trading profits. The more money they made for their desks, the bigger their paycheck. When you combine that pressure with the fact that Forex trading is largely unregulated and opaque, you create a perfect storm of corruption. Banks earn money on the bid-ask spread, the difference between what they buy and sell currency for. By knowing client orders in advance, these traders could widen those spreads, pocketing the difference. Over a decade, we're talking about potentially billions of dollars siphoned from pension funds, corporations, and everyday investors. The aftermath, the reckoning. The investigation that started in 2013 expanded globally. Regulators in the United States, United Kingdom, Switzerland, and Asia all launched their own probes. By 2015, the penalties started rolling in, and they were massive. Barclays paid $2.4 billion. UBS paid $1.5 billion. Royal Bank of Scotland paid $714 million. The list went on. In total, banks paid over $9 billion in fines. But here's what's disturbing, the fines were paid by the institutions, not primarily by the individual traders responsible. Some individuals were banned from trading, but prosecution was limited. What changed? The scandal exposed a fundamental problem, the Forex market's complete lack of transparency. After 2013, regulators implemented stronger oversight. The FCA in the UK, the Federal Reserve in the US, and other authorities increased surveillance of Forex trading and raised compliance standards. Banks had to implement stricter controls on their trading chat rooms and improved record-keeping. Today, the Forex market is more heavily monitored, but many critics argue it still lacks the transparency of equity markets. The decentralized nature of currency trading means complete regulation remains a challenge. The bigger picture. This scandal teaches us something crucial about financial markets. When incentives are misaligned, regulations are weak, and accountability is diffuse, corruption thrives. It didn't matter how prestigious these banks were or how many regulators supposedly watched over them, systemic pressure created systemic fraud. This video is for educational purposes only and does not constitute financial advice. So what did you take away from this? Does it change how you think about the financial system? Let me know in the comments below, and if you want more deep dives into financial history's wildest moments, hit that subscribe button. Thanks for watching.